Ion Exchange, one of the leading players in the water treatment and pollution as well as waste management, has actually seen its business getting impacted because of the COVID-19 pandemic, particularly in the light of its exposure to industrial clients and segments. Now, in our Ideas for Profit today, I will discuss whether investors should really keep this stock on radar for the long term and should take advantage of the short-term pain. Let's look at the earnings first. Now, first of all, during the Q4 or the March quarter, the company reported close to 19% drop in the consolidated revenue this time. Also, its engineering division, which actually forms close to 60% of the total revenues, saw a steep 25% year-on-year dip in the revenues to about 220 crore rupees. Now, engineering business is largely an industrial turnkey project-based business, which is actually suffered during the lockdown as customers deferred projects and dispatches also suffered. Particularly, revenue recognition of its Sri Lanka project suffered in the light of COVID-19. Relatively, the company's other segments, say chemicals, did quite well. Also, revenue dropped marginally by 8% on a year-on-year basis for this segment. However, the segment margins were higher because of the increased capacity. Now, this really helped in protecting the profitability front as well. Chemicals form merely 30% of the revenue, but its contribution to the profitability was quite high, and the company was really able to absorb the losses from the consumer business thereof. Consumer business reported an EBIT loss of 28 crore rupees in Q4. Now, the company has indicated that all of its facilities are now operational and gradually the dispatches are also normalizing with the ease of lockdown, and this is good, particularly for the engineering division, which actually accounts for the bulk of the revenue. Now, post permission from the government, the company has also resumed the supply and has also started to work on its Sri Lanka project also now. Now, this is reflected in its March quarter results, where the revenue and the profitability really dropped marginally and order inflows were muted as well. Still, the impact of loss of revenue in the first quarter of the current fiscal year will be visible, and recovery will mostly be expected in the second half of the financial year. Now, the company has been making efforts to bring down the working capital also. However, this could again increase in the light of the stress in the industry right now. Thankfully, the company is sitting on a cash and cash equivalent of about 400 crore rupees, which is good enough to support liquidity in this period. Now, it is expected that losses in the consumer business would recover as volumes pick up post the lockdown. Chemicals will continue to have higher margins and profitability led by higher capacity, and this favorable revenue mix should actually help in maintaining the overall profitability of the company, even if pressure is seen in the engineering as well as in the consumer business. Therefore, on an overall basis, we are expecting that this year's revenue and margins could drop marginally. Both growth and margins should be better in the next fiscal year. We are definitely expecting good recovery in the earnings led by margin expansion in FY22. Now, the stock has corrected in the recent past from the 52-week high level of say 1071 to the current levels of about 695 rupees per share. Moreover, the valuations have turned quite attractive. At least at the current levels, it is trading at 6 times the FY22 estimated earnings, which is really attractive in the light of growth and the quality of earnings, also supported by the strong balance sheet. Investors can therefore look at accumulating this stock for the long term.